Good morning, traders and investors. My name is Roger Scott, and I'm the senior strategist for Wealth Press. Well, today is the day that we've all been waiting for. Not only is it the 15th of December, which means we're about halfway done with December, but today we've got FOMC. Now, it's about 7:24. We're going to be opening up in 2 hours and 6 minutes. And as you can see here, the markets are, I don't want to make too much of this. I mean, the Dow is up 2, the Nasdaq is down 18. Based on the volatility we've been seeing, this is random trading action, and I believe it's random right now because the market is waiting for an 8:30 report, a retail sales report. Now, this is going to be a very, very important report because it reflects, retail sales reflects two-thirds on our economy, and the report we're going to be getting from the Fed has to take this into consideration. So I think the market is waiting for this report, and if the report heats up really, really hot, then it's going to be evidence that the Fed has to take action. If the report is on the cool side, then it's going to give Fed some pause about taking action. This is a very, very important report. The consensus for retail sales is 0.8%, X vehicles 0.9%, X vehicles. Basically, everything is below 1%, slightly below 1%. And it's going to be coming out in about an hour and 5 minutes, an hour before the market opens. And it's going to set the tone for today's trading session. That's one of the reasons why the indices are just kind of not here nor there. The bond market is down second day in a row, even though the stock market went down yesterday, and it looks like we're going to turn lower. I think the bond market's going to go lower because there's really no catalyst for bonds to go higher because we know the Fed is going to take some action. It's just a matter of when. If you look at the put to call ratio, we're just now starting to get back into the random zone. We were ultra bearish. These are ultra bearish signs, and we're now back in here. Now, here's what I want to tell you. It's really important. If you look at the Russell 2000, which is the small caps, and small caps tend to do well last quarter of the year, we are right now sitting at the lowest momentum levels, average momentum levels. This is COVID. This is COVID fears, and I don't know what this was, but typically, if you look back, this is a weekly chart. This is going back to February 2017. Look at where we're at right now, near 20th percentile, 20th percentile, 20th percentile, 20th percentile. Let me go to a monthly chart. That was a weekly chart. 20th percentile, 20th percentile, 20th percentile. Only 2 times in, what is it, how many years is that? That's 8 years have we broken these levels, and it looks like we're turning right here too. So as far as I'm concerned, the Russell is going to rally from here. And if you look at the price chart of the Russell, which we will look at right now, you will see that it has a nice double bottom with the second bottom higher than the first. So if we rally from this, or if we go a little bit lower and rally from here, it would make a lot of sense and then take out the 200-day line. It would be a political shakeout, not a political shakeout. It would be just a term I'm using. It would be political shakeout based on the environment we're seeing right now. But I wouldn't be surprised if we shook out and started moving higher across the board, especially with large caps right now. Don't be surprised. Volatility is not really going higher. This is just gyrations. Typically, after we see a spike like this, we cool off. Not expecting too much volatility. Matter of fact, we're up just a hair. The bond market, as I said, is lower right now. And let's talk about industry heat map. This is a 1-month performance. Now, if you've been watching me, if you've been paying attention to what I've been saying, then this is not a surprise for you because I told you that defensive stocks are going to start leading. 1 month, insurance, travelers, hello, consumer staples. I told you guys a month ago, utilities. If you go back to a 5-week trend, you will see that large cap pharma, consumer staples again, medical, waste removal, defensive stocks. So again, market is being defensive, but I'm looking at a chart. Let me just show you this. I was looking at a chart this morning of consumer discretionary, which took it really bad the last few days, had a nice big sell-off, and even consumer discretionary broke the 50-day line, and it looks like it wants to go back. I wouldn't be surprised if we go back up from here, because this is where a lot of traders got shook out of the position below the 50-day line. A lot of traders know that to get out of a trade when it goes below the 50-day line. And right now, it could just kind of sit here a little bit and then go up. Now, if we have 2 days above the 50-day moving average, we have good clearance. This asset should go back up. The only concern I have is that this second top is way, way lower than this first top, but we've been having a lot of drama on Wall Street. So don't be surprised to see consumer discretionary, and let me see if chips are in the same boat. Not yet, but don't be surprised if we saw a little uptick on broad market today, including consumer discretionary stocks. Let me give you the overview of what to expect today, and this largely goes into what we've talked about. It'll kind of fill in the holes for you. World shares mixed Wednesday. We're waiting for the Federal Reserve. That's happening between 2 and 2:30. We're first waiting for the retail sales report. As you could see here, retail sales, manufacturing, import and export. These are all very important reports heading into the FOMC. And then we have the Fed conference at 2:30. So it's going to be a very, very volatile day. Don't make heads or tails of this market till you hear from me. I may do another video talking about this after the FOMC over, or catch me in my VIP room today. But the point is, we've got a lot of data. Retail sales, FOMC, import, export, that's a lot of information. Let's go back to our write-up. Federal policy makers end a two-day meeting Wednesday where they're expected to speed up the withdrawal of economic stimulus measured to help tamp down inflation. If they don't do this, stocks are going to go crazy. China reported its retail sales slowed in November as the country sought to extinguish COVID outbreaks. China reported its retail sales slowed in November, rising only 3.9% from a year earlier compared with 4.9% in October. It's not too bad. Industrial production picked up slightly. So the numbers are mixed, 3.8%, 3.5%. They're not that off. Second Omicron case was reported in China, underscoring the persistent threat of infections. But again, if this Omicron is not a big deal, then it's not a big deal. Businesses have been dealing with supply chain problems, higher costs for months. That's the point, months, which means it's mostly priced into the market, and are passing these costs to consumer. Look at consumer staple prices and look at the consumer staple index. That's why I told you guys consumer staples are going to go up like crazy, who have been so far absorbing the higher prices on everything from groceries to clothing and other consumer products. Now, on Friday, we report consumer price. Last Friday, we reported the consumer prices surged 6.8%, the highest increase in 39 years. But of course, it's transitory. Transitory. Yeah, tell that to your checkbook. It's transitory. When you don't have any money in your wallet, it's transitory. Yeah, transitory. Anyhow, the discouraging report on inflation preceded the Federal Reserve meeting, which started Tuesday and ends today. The Federal Reserve is expected to move quickly to trim bond purchases, which have helped keep interest rates low and support the stock market and broader economy. Beyond that, investors are watching the central bank for any statements on how soon it might raise rates in 2022. I think the Fed is going to slow down because of this Omicron, or may take things a little slower, which will cause the market to rally. I think the market is setting itself up for a rally. Energy remains stable. Now, folks, today is Wednesday. What do I do Wednesday? I give you a long trade and a short trade, actionable trading ideas. For the long side, I have Advanced Auto Parts. I like Advanced Auto Parts, and I like it where it is right now. I would put a stop loss right at the 50-day moving average. If it breaks this 50-day moving average or slightly below, I would get out, and I would have a profit target of about 250 on this stock. If you're an options trader, that's cool. I would recommend the March, let's see here, 235, the March 240 right here. Not too bad. Or you could do a spread between the 240 and the 270, but it's not really going to take too much off. I would just buy the 240 net. But again, you could do the 240 and offset by the 270 if you want to offset by a few dollars. Again, I wouldn't really do that. You can even do the 240, 260, but I wouldn't do that. I would just do the 240 net. To the short side, we have Conagra Brands. Now, this is a consumer staples company, but it's been doing really, really bad, and now it looks like it's peaking out right at the 200-day moving average. I think it's a good short opportunity. I may take advantage of this to the short side. It ran up from $30 to $32.50 in the last couple of weeks, or last 2 weeks, and I think it's going to come down. And in this case, we want to do a put. And in this case, we would go to 318, and we would go to the put side, and we would go to the $30 strike price looks good, but I'd rather get the 32. I like the 32 better. I like the 31 or the 32. It's closer to the money, probably 32. Yeah, you want it's not expensive. It's a cheap option. It's close to the money. That's the direction I would go on this one. So I would go March 32 or 31 strike price on the put. Ticker symbol CAG. Now, folks, be careful today. We're going to have a lot of volatility. I think markets are setting themselves up for a nice little upside. But again, with the Fed data, with retail sales, it's very hard to say. So you've got to be very, very cautious right now. But here's what you need to pay very close attention to. A 3 o'clock burn window, as Joy of the Trade head trader Jeff Zananeri calls it, it's allowed anyone to potentially buy low, sell high, sometimes just 18 hours later. And last week's 4 new trades all closed winners. Join Jeff to celebrate the burn-iversary. That's right, the burn-iversary, and raise a virtual toast to the first anniversary of burn notice alerts. This is big, and Jeff's been killing it. He'll go over the year's track record as well as the current portfolio, giving you a sneak peek of what's inside right now. Click on the link below to sign up and take a deep dive into burn notice alerts and how they work. And folks, Jeff's managed money. He used to be an institutional trader. He's really good at what he does, and he's going to teach you all about burn notice. And if you haven't joined the program, you'll get to see the real deal. You'll get to see how good it is. You'll get to see the trades. He'll go over the spreadsheet. He'll go over the winners, the losers, the good, the bad, and the ugly. But you got to follow the link below to learn all about it. Do it now. And as always, make sure to like these videos. Subscribe to this channel if you're watching on YouTube. Stay ahead of this market. Be the first to be notified when I post my next video, telling you that consumer staples are going to break out a week and ahead, telling you that chips are going to fall a month in advance, telling you that the bond market's going to cool off, and all the other stuff. Tomorrow, we're going to talk about top ETF and top option picks. I'm excited. Don't go crazy today with stop losses. Give your positions a little room to breathe and follow the link for burn notice. And send me some love letters. I want to hear some feedback from you. Support@marketgeeks.com. I want to know if you're getting some value out of this. The good, the bad, and the ugly. Bye, guys. Take care and have a good one. Be careful today. Keep your seatbelt on.